cut price. You hope volume will increase, but you're not seeing the kind of volume increase that is commensurate with the price cuts. What about this Model 2 that they expect to bring out in 2025? Is it going to be a game changer, or is it too little too late here?
Well, I mean, I think that was the other part of our report today. We were looking at the potential for Model 2. I mean, and one of the things that really is concerning to me is that it's different from other launches. This is a mass market priced SUV. That's going to be very tough to do. I mean, the actual, if you go to an internal combustion engine, compact vehicle today, they're not very profitable. You add on an e-powertrain, you're probably starting off at a losing point. And then if you're then really betting on this unboxed production, which is the new manufacturing methodology they plan on launching with the Model 2. That's a bit of a wild card. It's just never been done before, and we still estimate you need most of those benefits to come through to get this to profit levels that we're seeing on their current vehicles. What does
unboxed production mean? I noted it in your note, and I wasn't sure what it meant.
Yeah, I mean, it is a new term. No one has actually done it before. So the idea is it's a change in the entire assembly line. And from experts that we talk to, they're trying to eliminate all the bottlenecks, automate as much as possible. The vehicle won't run through one line. It'll actually be assembled in different subcomponents and then come together at the end. This enables, one of the potential benefits maybe is you could put more throughput through the paint shop, which is the bottleneck today. But also you probably could automate more along the line and eliminate some of the manual inputs. So it's supposed to improve your efficiency. What we found in our report is that, there's probably between labor and fixed costs that are absorbed per the vehicle, it's probably $9,000 to $10,000 per car. So if you could double that, there's like $4,000 to $5,000 in benefit. You really kind of need most of that benefit to get Model 2 to probably profitability given the powertrain costs you'll be adding.
We're in a difficult spot for Tesla. If you look at the company, it was at a 55 multiple. Now it's at 50 times earnings roughly on street numbers. If you look at the conventional or traditional OEMs, they trade between 4 and 6 times earnings. And at this point, when you're seeing all auto sales kind of slow down and the traditional OEMs are pulling back on their money-losing EV operations, investors now look at it and say, hey, maybe these are bargains here in traditional auto OEM land. And those stocks are doing pretty well. And at the same time, I think the long term is, still very interesting for EVs. I think the long term we're going to see an EV S-curve in terms of replacing traditional ICE cars in the long term, but in the short term, the view or the tide is going out essentially on favorability for EV stocks, and with a multiple differential of base almost 10x for Tesla versus traditional OEMs. That's a huge gap, and I think at this point in time, we expect to see Tesla's multiple continue.
If you're considering adding Tesla stock to your portfolio or wondering if it's a stock worth holding onto for the long haul, then this video is for you. So far this year, it's been a bit of a roller coaster ride for Tesla's stock and Tesla investors too. The automaker's shares, which were once a treasure in the stock market, are now trading way below analysts' expectations, and all investors can do is wait and watch out for the day on which Tesla's stock price would pick up again and become the high-value stock that it once was.
Well, Tesla shares falling more than 30% since the start of the year, with a number of factors leading to that decline. The EV giant has received several analyst downgrades, including one from Wells Fargo on Wednesday. There's also concerns about a slowdown in EV demand. Let's talk about where investor sentiment is likely to lead to now. Ross Gerber, Kawasaki Wealth and Investment Management CEO, joining us now. Ross, we always like to talk Tesla with you, but I wonder where you think about where Tesla has fallen right now. Is this just about Tesla coming back down to reality where fair value should be? Or are there fundamental questions about its growth potential now?
Well, unfortunately, I think it's kind of both, in that the original story that I think most investors bought into with Tesla didn't really include Elon and Twitter. And I think for a long time, we all hoped that it really wouldn't affect Tesla and the demand for its products. But we all know that that has now happened, and the demand for Tesla products is obviously lower, and they've had to discount and do many things to hurt margins and returns and ultimately, profits for Tesla. So, you've got that problem, which is where's the bottom when they don't advertise and they don't do anything to create demand, but the CEO of the company every day goes out and hurts demand through his actions, literally every day. Yesterday it was Don Lemon and Mr. Free Speech, oh, but I don't like the guy who interviewed me, so he's fired. That's not free speech. So I think, investors have had enough, and we see the fallacy in this business model now where the king of advertising the brand is now the devil advertising the brand, basically.
So Ross, I mean, this is tough, and I know you're someone who, this is a company that you like, that you follow.
I love the company.
Exactly. So how hard is it then to try and value this company that started off as a car company, then is considered more of a software company, and then you bring in some of the personality of the CEO as well coming into the mix? How do you end up valuing accurately Tesla?
Well, the way we've always valued Tesla is a tech company. First of all, in its heyday, it traded 100 times forward earnings in the end of 21 when things were, as good as they could be for Tesla. And so part of it is a valuation coming back down to earth. And when you align it with forward multiples from Microsoft, NVIDIA, Google, Apple, the Mag 7, let's say, 35 to 40 times forward earnings makes a lot of sense. So if you're looking at $3 for this year, that's how the Wells Fargo guy gets to 125. And so, 40 times earnings seems like a fair multiple for a company that isn't growing earnings, but has an incredible potential future. But, this could turn around very quickly if either like Tesla gets a real CEO who's actually going to help the company, or Elon changes his tune and actually comes back to working at Tesla and promoting the brand in a positive way. So they've got great products. The Cybertruck is amazing, but it's just literally a business lesson of an amazing company being brought down by its CEO.
As of the time of this video, Tesla's stock is down by more than 30% compared to the beginning of the year. A pretty significant chunk of change, I must say. And this decline is a bit surprising, considering that Tesla used to be the golden boy of the EV market. Tesla was zooming past the competition and its stock price was shooting up like a rocket. However, this year things have been a little different. Already, some analysts predict that Tesla might not grow sales as much as expected in 2024. And that's not a good look for investors who want to see companies expanding and making sweet profit. On top of that, Tesla has even had to cut prices in some markets to keep cars moving off the lot. And while this might bring in more customers, it also means less money coming into the company. So what happens now? Should we sell off our Tesla shares before the stock price plunges even further, or keep them for the profitable future? This next clip could give you an insight into what the next step should be.
Yeah, but Ross, you said you value it as a tech company. I mean, what's the tech catalyst here? For months we heard from so many Tesla bulls who said, look, this is an AI company, but there's not an AI product out there. When you think about autopilot, it's not at the level 5 that was claimed to be.
No, it's not an AI company, and Elon's made it clear he's not going to build AI at Tesla, which is even more upsetting to me, especially because Tesla could have owned OpenAI in hindsight, and boy, that's worth now $100 billion. So, there's a lot of stuff going on here, but Tesla's technologies, battery technology and scaling advanced battery technology, 4 megapacks, for example, for utilities, the technology behind the Tesla manufacturing process, as well as the battery production process, not to mention full self-driving, which is still an impressive piece of technology. But what they've done is they've been able to scale EVs like no other company's been able to do in the world. And so we now see for sure the moat that Tesla's built is pretty deep, being able to make 2 million cars and nobody's even close. So I think, it's not a car company, that's for sure. I mean, can you call a Cybertruck like a regular truck? It's not a truck company. So I think it's a tech company, but it still doesn't change the reality that companies trade based off the perception of its future earnings. And now that perception has changed to a much lower perception of future earnings. And that's why there's so much pressure on the stock. And once again, it could be reversed immediately if Tesla took actions to improve the brand and advertise its products.
And Ross, I have to ask you, because as we talk about the Cybertruck here, another one of these halo products gets more eyes than you're seeing, especially these early adopters very keen on it. But was it a misstep then to not focus on cheaper, newer Tesla vehicles versus sort of this price cut up and down that people are seeing as well? What would have been perhaps the better strategy here?
Well, no, I don't have any issues with their strategy, and the car is very reasonably priced now with the discounts and the EV credits. So you can buy a Tesla for in the mid $30,000 range, and if you're smart, you can buy a used Tesla for way cheaper. And there's actually like very little or no depreciation in Tesla's actual car performance. So if you buy a 2 or 3 year old Tesla, it works just as good as a brand new Tesla. So, you know, for investors or car buyers out there, there's an amazing opportunity to buy like a used Tesla at a very, very reasonable price and still get an EV tax credit. So I don't think they need to make a more affordable car right now because they're having trouble selling the cars they have, and they think it's price, but it's really marketing. And so the amount of misinformation about EVs out there is just at an all-time high because they continue to be more and more successful gaining market share against gas cars. And so, you know, the FUD and the misinformation just ramps up the more success Tesla has. So as a company, Tesla's amazingly successful, but for it to move to the next level, they're going to have to change their strategy.
Tesla stock is highly volatile, but we'll also agree that volatility provides investors with entry points to take advantage of stock prices. So what if this market volatility is the perfect environment for investors who play the long-term game? Shouldn't they be buying additional shares of Tesla at lower prices in order to get more returns on their investment in the future? Hello everyone, and welcome back to Tesla Tomorrow. The past few weeks have been a different ride for Tesla investors. First, Morgan Stanley Tesla bull Adam Jonas issued an investor note in which he cut his Tesla 2024 earnings projections by 25%, saying that the EV giant could potentially lose money this year. Next, Wall Street disclosed that it expects Tesla earnings per share to drop to $2.96 a share in 2024, which is around a 5% decline from last year's earning per share of $3.12. Even Wells Fargo downgraded Tesla to underweight, with a price target of 125, down from 200. And now, some analysts are saying that Tesla's Q1 delivery could be a miss. No doubt, all these are enough to make any investor become bearish on a stock, but do they really have to? Some investors are choosing to keep this stock for a longer term. But why? Let's find out. But before we do, if you like this type of content, make sure to hit that like button, subscribe to our channel, and turn on notifications to stay up to date on everything happening with Tesla. First, Tesla is the most innovative company today. The automaker's commitment to technological innovation is a key factor that sets it apart from its competitors. Tesla is not just an automaker, but also a pioneer in renewable energy, battery technology, and autonomous driving. The company's advancements in battery efficiency and production, as well as its autopilot and full self-driving (FSD) capabilities, have reshaped the industry and positioned it at the forefront of the clean energy revolution. Which means that by continuously pushing the boundaries of what's possible, Tesla is poised to disrupt multiple sectors and drive long-term value for its shareholders.
To Trading 360. It's time for our 360 round. I want to talk all about EVs and lithium too. Dryden Pence is with us, Chief Investment Officer, Pence Capital Management, and Seth Goldstein, Equity Strategist, Energy and Resources at Morningstar. Thank you so much for being with us. I'll start with you, Dryden. You know, I keep asking, are EVs still hot? Hertz just had a change in the C-suite because they were betting on EVs and a lot of Teslas, and now changing that and selling off those Teslas and going to use that to buy combustible cars. Once again, they said that it was high operating costs. EV demand wasn't so great, had been waning, I guess, and also had some safety issues. How do you feel about EVs overall, Dryden Pence?
Well, overall, we're still very supportive about EV, both in the electric vehicle space in and of itself, and then when you take also look at hybrid technologies. So I think that it's very important for us to recognize that this is a natural progression of adoption of new technology. The early adopters have pretty much done it, right? So you had the wave of people come in early, but now you have the kind of secondary adopters, and the market's maturing. Obviously, Hertz ran into a big problem, probably a bad corporate decision because there's not enough infrastructure throughout the country to do it. But if you take a look at California, that has a lot more infrastructure, 25% of the sales of cars are EVs. So it's as this infrastructure spreads out across the nation and indeed the world, that we're going to continue to see this growth. And 42%, or a lot of countries are pushing EV globally. So when you see these phase outs coming, we see adoption in various countries. We think long term EV market is still very, very strong, but we've just seen this wave of early adopters, and now we're going to kind of modulate as we move through it. So we think it's a long-term trend that's here to stay. It's not going away.
Yeah. And Seth, you're on the same page. You said 40% adoption by the year 2030, right?
That's right. I mean, when we look at our cost and function framework, we tend to think of EV adoption as, having an early market and then a mature mass market. And in order for EVs to win consumers over in the mass market, where consumers are very practical with their purchases, they need to have the same cost as an internal combustion engine, and there needs to be the same function. So long range, at least 300 miles, there needs to be the availability of chargers in a particular region. We've seen that happen in China, where there's been a massive build out of high power chargers. And even though the subsidy expired in 2022, EVs still grew rapidly in 2023. The US is a little bit behind, Europe is a little bit behind China. And so we think those markets will get there, but it's just going to take some more time for there to be more affordable vehicles to hit the market, so consumers have more options in those lower price segments, and for the fast charger to get built out along highways and in cities.
Tesla has massive opportunities for growth. The automaker has been rapidly expanding its presence in key markets worldwide, including China and Europe, and these global expansion efforts are contributing to its long-term growth prospects. As Tesla's global footprint expands, so does its potential customer base, creating a solid foundation for sustainable growth in the long term. Think about it. Despite lingering issues in the fiscal year 2021, Tesla's sales revenue reached $53.8 billion, with 936,172 cars delivered to customers. This increase in the number of deliveries and its profitability of $5.6 billion pushed the company's market capitalization to over $1 trillion, surpassing the combined market cap of the top 5 automakers at the time, namely Toyota, Volkswagen, Daimler, Ford, and General Motors. Now, Tesla's market cap is already drawing close to $600 billion as of the time of this video, and its stock performance, even though is not very impressive, is still quite promising. It is therefore expected that if Tesla continues to grow at a good rate, then it may one day attain Elon Musk's goal of being the most valuable company in the world. And who knows, this could probably happen when Tesla eventually achieves full self-driving. Judging by the massive opportunities that come with achieving full self-driving and the amount of revenue that Tesla can potentially make from this, it won't be a surprise if Tesla's valuation skyrockets after FSD.
I mean, just the growth projection feels fast. Is it, Seth? Because right now you're talking about 40%. You said 20% growth for 2024. I mean, no one I know is itching to buy an EV. I had 400 people at my wedding. I don't know anybody who's saying, I can't wait to buy an EV this year. I work on the floor of the stock exchange. I just am not hearing it. I'm sure it's there. I believe you when you say 20% growth in 2024. I just don't know how you're going to get to 40%. What are we at? Not even 5% adoption right now? How are we going to get there?
So for 2023, the U.S. had about 7.5% battery electric vehicle adoption. Globally, that was more like 12% due to much higher adoption rates in China and Europe. We see those markets continuing to lead the way, and we think China will be at 60% by 2030. Europe will be at 50%, so above the global average. The U.S. will get in line to 40%, but in the near term, in 2024, the bulk of growth will come from China and Europe, where we see more affordable vehicles, we see more charging infrastructure along major highways, and so the U.S. will continue to be a laggard in the near term, but will catch up in the coming years as the chargers are built out.
Yeah.
Tesla has become a household name, and beyond just making cars, it is now known for several important things. And this one factor has elevated the company, especially in terms of brand loyalty. Tesla has built a strong brand around its innovative technology and commitment to sustainability. The company's brand is associated with luxury, performance, and environmental responsibility, which has helped it attract a loyal customer base. During the first 4 months of last year, Toyota saw a notable decline in its rankings, and part of that is likely due to electric vehicle maker Tesla. Although there are a lot of factors that could have affected Toyota's brand loyalty, the effect of Tesla's presence in the market is definitely becoming palpable. This is a company that is known for its advanced electric vehicle technology, including its batteries, electric motors, and self-driving capabilities. A company that invests heavily in research and development and continuously improves its technology to stay ahead of competitors. Think of all that Tesla can do in the future, and also think of the company's strong cash position and positive free cash flow, both of which can provide Tesla with the resources needed for future expansion, research and development, as well as strategic acquisitions.
Caleb Silver's with us, editor-in-chief at Investopedia. Lots to discuss, and I know you brought some great pieces of news about how people are feeling. I want to check that out in a moment. First, let's just start. It's Fed Day, right? So what are we expecting or not expecting?
I'm thinking gray suit, purple tie in honor of spring, the cherry blossoms in Washington, because he's not going to say much about interest rates. We know that, except they are not ready to lower interest rates. Inflation is still lingering here. And guess what? The economy has not broken because of these high rates, even though they're at the highest rates since the great financial crisis. We've had some issues with banks, certainly. We've had higher pressure on consumers, given those interest expenses. But GDP is still strong. Unemployment is under 4%, and not that they say they care about it, but we got kind of near all-time highs here at the stock market. That's the wealth effect at play.
Yeah, and you know, September, right, is really where people are looking now. It went from July to September and then skips because it's the presidential election, and then maybe December again. That seems to be, maybe is that the way the Fed's going to go, with pauses in between meetings?
Yeah, we went from June to September pretty quickly. We didn't even stop in July, so potentially, but it's all data dependent. You'll hear Fed Chair Powell say that today over and over. Data dependent. The last CPI report came in hotter than expected. And guess what? Energy prices are kind of rising, and we're not seeing deflation. Maybe we'll see disinflation where prices stop rising, but no deflation. Prices aren't going down.
One thing that Tesla investors need to always remember is that Tesla's revenue is diversified. Aside from its car business, which has made massive profits, Tesla also has several other revenue sources. Already, electric cars are known to be the future of the transportation industry. That is something on which the majority of people agree. The only remaining uncertainty is when this change will occur. While Tesla's business model is skewed toward the automotive segment, other segments like services and energy storage and generation will also play a key role in the future. FSD and robotaxi will contribute massively to Tesla's revenue, combined with its supercharging business, which has been gaining a lot of momentum lately. There's also the insurance business, robots, mining and refining, not to even mention the Dojo supercomputer. There's just so much in store for Tesla and its investors. So what's the verdict? Is Tesla stock a buy or sell? Well, it's not all doom and gloom. There are still some believers out there who think Tesla's just having a temporary setback. These bulls point out that the car company is still a leader in the EV market and is constantly innovating with new technology. Plus, remember how much Tesla's stock soared last year. This year's decline might just be a correction. So, what does this all mean for you as an investor? First, let me say that it all depends on your investing style. If you're a risk taker who sees this as a buying opportunity, then maybe Tesla should be on your radar. But if you're more cautious, then you might want to wait and see how the rest of the year plays out before you jump in. But no matter what you decide, one thing's for sure, Tesla's stock price this year is definitely a story to keep an eye on. For us, we think it will be interesting to see if the automaker can turn things around and get back on track, or if this is the start of a longer-term slump. By the way, let us know what you think in the comments section. And if you would like to know what Tesla has been up to these past few days, go ahead and click on the next video on your screen. See you there.